Rohr here with an early concise highlight on Friday, July 11th, 2014. It's currently getting to be 7 a.m. U.S. Central Time, and this is going to be quite concise today because the equities stabilizing a bit yesterday has left everything else steady from the previous moves we saw that were reviewed so extensively in our Global View video analysis on Thursday morning. For anything more extensive we don't cover here, please refer back to that and the blog post. So, kind of a lack of really trend decisive fundamental input at present, and we're going to see the technical trade in the equities pick up with the short-term charts of the U.S. S&P 500 future. That's, of course, as usual, hourly on the left, 30-minute on the right with indicators below. And as we were focused yesterday on whether the September S&P future was going to break the 1950 level, it did, but only temporarily. By the end of the first half hour, it was right back in the area. By the end of the first hour, it was back above it. And that might have still left a stall out into the support that it held going back pardon me, to Tuesday in the 1953 to 55 area. But once it started to hold up above that, it was clear it stabilized again. It doesn't make it a great big bull necessarily once again. In fact, based on the spike low yesterday morning, we now have a downward overall channel that's right back up around the failed support, Fibonacci support around 1964 area early today. And that's going to be the near-term resistance. And also they still did leave a bit of a residual gap lower after the significant gap down on the opening on Thursday. And headed up here, filling that gap, of course, would only take them back right up near the key close we were looking at early this week, which was last Wednesday's 1967.70 that it gapped up from eventually. It traded steady in the immediate wake pre-regular trading hours on the employment report initially, but from which it gapped up once regular trading hours opened. And holding that Monday but breaking it Tuesday put the market under pressure, and that would still be some pretty key resistance given it's also right into the top of the gap down from Thursday morning. Lower support would remain right around 1953 to 55 initially. We'd still give that a buffer to just about the 50 area. And if it were back below there on a more sustained basis, the lower supports are down at 1938 to 35 area. And that is really pretty much it, because the indicators aren't really telling us very much right now. With the lack of downside follow through yesterday, the MACDs never got anywhere near their lower runaway bands, and the stochastics are also a bit betwixt and between right now, although we could make a case that the rally yesterday and then stalling has left the hourly hourly stochastic in more of a negative frame for now. And that's pretty much it for the short-term view of the S&P 500.